All right. Good evening, everyone. Welcome to the Animal Markets live webinar. Today, we're going to focus on waves. Is everyone excited? Waves and fibs. But today's first webinar out of a two-part series is going to be focused more on the wave theory, Elliott wave theory to be precise, or wave analysis, wave patterns. Before we dive into today's topic, though, two disclaimers. First, explaining the fact that the webinar is shown to a global audience, but may not be suitable for everyone. Please visit admiralmarketsglobal.com, select your country of residence, and contact the appropriate entity for more details. All right. Also, please note that trading foreign exchange and global financial markets is considered high risk. Please seek the advice of an independent financial advisor for more information on that. This webinar is for informational and educational purposes only. By continuing watching this webinar, you agree with this disclaimer and you are aware of the risk involved when trading. All right, today only me. I will be focusing on the waves. Then it will join us again in September. And let's kick off. All right, so who in this webinar is using waves already? Write a Y for yes. And who in this webinar has not started yet, right? So, or maybe we can use a number. If you feel like you've used the waves a lot, write a 10. And if you haven't used it at all, write a 1. So according to your experience level, if you think that you've used it a little bit, maybe you can write a 5 or a 4 or a 6, just to get a feeling for whether there's a group of new people here, totally new to waves, or more people that have used it for a little bit. Interesting. A lot of new people. All right. Four ones, basically. So, okay, this webinar was not really intended, but we hang on there, don't leave right away. I just wanted to give you an indication that it could be good to go to the YouTube channel of Admiral Markets, and I will send you the links for basically webinars that explain, let's say, more of the basics. Because I'm not going to explain where it originated. I'm not going to explain the rules, the basic rules, the basic ideas. That was not intended for this webinar because we covered it already in a two-part series a while back. So I will send you those links. All right. But that said, I did want to make it anyhow still very practical. So let's take a look at that together. So my advice always when looking at waves is that basically we should start simple. Don't overdo it. Don't try to do too much at once. Don't try to trade based only on waves from the very start. You want to take it gradual, you want to build experience in it, and you want to use it as a supportive tool at the beginning. At the very start, you don't even want to think about waves and identifying wave patterns or even thinking about labeling wave counts. It's not needed. It's too complex at the beginning, and it's going to be difficult to do it correctly. It's going to be frustrating, and most likely going to give up because it's too ambitious. You got to take it step by step. The first step to actually learn is to recognize and understand momentum and correction. That's key. So this is the heartbeat of the market. Anyone looking at momentum and correction is actually a mini Elliott waver without even knowing it. They might not agree, but in my opinion, they are, because Elliott wave is all about identifying momentum and correction, bullish and bearish. So you have bullish momentum, bullish correction, bearish momentum, bearish correction, right? Before we start analyzing that, we need to know what is momentum. We need to know what is correction. All right. This again is also not part of this webinar. We have other webinars for that. That's why it's so good to go to the YouTube channel of Admiral Markets. Type in search waves. Type in search momentum. It's very easy. Just find Admiral Markets YouTube channel. All right. I'll show you the link at the very end. As you can see in the image here, momentum is the black arrow, sorry. The green arrows are corrections. right? And each of these is one swing. So from circle to circle is one swing. So the first task or the first step is to understand this. What is momentum? How do we recognize it? How do we see it? And when does it end? Then we know when there's momentum. Then we know when there's correction, and we know there's been a swing. Fractals is very good for identifying swings too. So when you have that, when you understand what is a swing and how you can see it, which is, as I said, a different webinar, then you can start to think about, okay, maybe I can do a next step. All right, so understand momentum correction. Then you can start thinking about recognizing the last few swings. Not too heavy, just look at the last two or three, try to understand what they are. So we see bearish momentum, bullish correction, bearish momentum, bullish correction. What will be the next piece of that puzzle? Yes, potentially bearish momentum. So it's like a puzzle. You have 500 jigsaw pieces, and you have 100 already laid out in front of you. And you find a piece, and you're like, oh, that seems to fit there, right? So waves is nothing different in a way. You're looking at the pieces that have been on the table before, that's the past swings, and you're trying to then see if there's a sequence that can give you an edge. What will be the next swing like? What will be the characteristic of the next swing? That is all that wave analysis does. It sounds maybe scary to some of you. It sounds maybe complicated to some of you. It sounds maybe undoable to some of you. But if you really break it down to what is it, it is not that complicated. It is not that difficult to grasp. It's just trying to estimate what will be the next swing. What will be its nature of that swing? And the wave analysis gives us an edge in that. All right. And of course, the next step is then estimating what the next swing could be. And after that, we start labeling and stuff like that. So take your time, take it step by step. Don't use it for trades at the beginning. Just use it to understand the market structure better, to understand where there might be interesting trades. But then look for your confirmations. Look for tools that you've used in the past to confirm trades. All right. That will be important so that you don't get caught up in trouble in a way by trading it too soon. So once again, start with learning momentum correction. That's the first thing. Don't go into detailed wave debates as yet. I know that there are traders out there that go into the fine details of whether that is a wave 5 or potential wave B, and they have different scenarios, and there's nothing wrong with that, by the way. If you're one of those traders, great, right? Perfect. But if not, then at the beginning, it's not good to be that way. It's okay if you get the experience and you build that up and you know what you're doing already, but not at the beginning. Then you want to start with small parts of the swings to analyze them, and also wait for parts of the waves that make sense. Everyone knows, or most of us know, that the wave pattern is built on 5 impulsive waves and 3 corrective waves, right? So if you see clear 5 waves, right, to the upside like this, then you might expect an ABC correction. You can use it in a very useful, in a very practical way. You can use it to skip trades, take trades, be careful, look for setups in a certain part. We'll dive into that in just a second. And then slowly but surely you can expand with time frames, looking at more swings, and then after that you can start labeling it. Is this a 1? Is this a 2? What would that affect? How would that affect my trading plan? I just sent a link, by the way, to those in this webinar of the first part of this 2-part series from 2 years ago, I see, by coincidence, also August 2015. That will dive into more of the beginning aspects of it. So when we look at 5 waves up, when we look at 3 waves down, which waves are the best? How could we trade it, right? Once we get to point that we want to do wave counts or we want to occasionally do it, how can we use it? How can we, what waves would make sense? So this is a 5-wave bullish 5-wave structure with the extension, extra 5 waves in the wave 3 green, 5 orange waves there as you can see. So, and then of course typically after these 5 waves, what do you get? An ABC correction. So what are the best waves? Well, obviously the waves that go with the trend and have momentum. That is typically, for sure, is wave 3. So the very best wave we can trade is the 3rd wave. It's expected to be the longest. We're never 100% sure if it will be a wave 3, but that's the one we want to try to catch. Second best are wave 1 and wave 5. They are also expected to be impulsive, but not as much as wave 3, but typically show good potential trades too. After that, typically a wave 2 or a wave A or C. Probably the wave C is the best. Then after that, wave A and wave 2. The least interesting waves are wave 4 and wave B because those are very choppy corrections, very slow corrections. Those are very difficult. It would be good to avoid those particular waves. So we want to avoid trading wave 4 because look at this small little piece here, right? Wave 2 is better because typically there's momentum. If you have a wave 1, a wave 2 could fall quite deep compared to the wave 1. So once again, wave 4 and wave B are the least interesting. Then wave 2, wave A, wave 2, then wave C, and then wave 1, 5, and then wave 3. So let's take a look at some of these setups. As you can see here, there's a 5-wave and ABC down. Wave 1 is testing the previous resistance with the green arrow and hits the previous top, stops there, makes a correction, then continues with wave 3. So how do we trade wave 1? Well, wave 1, if we want to trade the start of wave 1, right, we need to see divergence between the previous tops or bottoms, and in this case bottoms, so we have that. And we'll probably need to see on the lower time frame some potential break to the upside, like a break of this trend line, for instance. We'll use orange for that. Right? Could be a breakout and expected wave 1. A wave 2, for instance, could be a hook back. A pullback, we put a fib from here to here, and we're waiting for a retracement to the fib, and that's when we can start trading the beginning of wave 3. All right? If we want to trade the wave 2 itself, we'll be looking for shorts close to this resistance, for instance. Right? We'll be looking for resistances for a move back down. If we want to trade the start of wave 3, we'll be looking for a move to a fib and a bounce off the fib. And if we want to trade a continuation, we'll be looking for a break of resistance for a continuation. Wave 5 we don't want to trade, or wave 4 we don't want to trade, but wave 5 we could trade as it breaks through the triangle or bull flag for an upside breakout. That's how we would trade wave 5. Now, how do we trade wave A? All right, there's basically divergence between wave 3 and 5. So we're looking for a bearish candlestick pattern somewhere in here, or maybe even a break of a trend line to trade wave A. Wave B, we could trade it, the break of this resistance, for instance, like that, for a small push up. By coincidence, I did do it on the Aussie. It's not the best. On higher time frames, it's possible because there's still some decent space. Typically, though, what you want to be aware of is that although you can trade wave B, it is not the best wave to trade. It doesn't mean that we have to avoid it necessarily, but be aware that if you are trading wave B or think you're trading wave B, that the take profit has to be limited, has to be not aiming for a higher high. Even though you think you're in an uptrend, you got to realize that there's a chance of a bigger correction. And that's when often things go wrong. People take an entry here thinking, oh, the trend is up, I got a perfect entry, let the trend continue, or they're excited, right? And then they don't realize that they're in a wave B and they get caught and it turns into a loss. Because they don't realize that they got basically trapped in a wave B buy. So it's possible to trade the wave B upon the break of resistance, for instance, like that. Just be careful if you think it could be a wave B, because that means that the trend will not continue as expected. The wave C could be traded at the fib of wave B, the first turning spot, or maybe a break of a trend line like that for a continuation of wave C. So that's very quick how you can trade it, right? Let's dive into more detail. All right, first, corrections. Impulse happens less frequently because impulsive price action obviously is quick price action. What does that mean? It basically means that the price action will move in one direction for a short period of time, will cover a lot of ground, and will be very quick. Right? Within a few hours, it flies up or it flies down. Whereas a correction can last very long, choppy up and down, and could be 4 or 5 times as long. So what are we more likely to see? Corrections, right? They happen often. Market is correcting a lot of times. Eventually there will be a breakout. Eventually there will be momentum, but it can take time. So it's important to know and understand corrections before we dive into more of potential trade setups. So when we have an ABC correction, that could be a zigzag, which is a quick correction. It's something like this. Or you can see here an example, A, B, C, that's a zigzag, right? Or it could be a flat where price goes sideways. So here on the very left, that's sideways, right? Price makes an A, B, C, and it goes sideways. It could be a triangle, A, B, C, D, E, right? Where price makes higher lows, lower highs, and does something like this. That's a triangle. Now, those are single corrections, but sometimes price makes the correction more complicated and they become a double correction. What happened? Well, basically, after the ABC correction, we had a correction down and another upside correction. So instead of the downtrend starting here, right, because we just had an ABC, so we might expect a 5-wave down, but it didn't happen. Why not? Because basically there was another ABC down and another ABC up. There were multiple ABCs in a row. There were multiple corrections in a row. That's when you have complex corrections, when you have not one correction, but a few in a row. Double, triple corrections. So that's when we use WXY. Why? Because basically ABC makes a W, and then we got an X, and another ABC makes a Y. And that Y made, in this case, an orange W. So this is a very corrective, as you can see, because there's a green X, right? And there's a pink WXY, of an orange WX, with a lot of ABCs within WX. Very, very choppy. And is that surprising to you? No, because price is going sideways. So this is complex. It's difficult to trade too, as you can imagine. This particular chart, because it's a tight range, narrow range. This range at the beginning has a little bit more space. Why? Because there's momentum here. And there's even momentum here. But this went into a range. So what interesting trades could there be here? Well, as I said, the wave 3 is the most interesting. So this part, right? This part. This part. Those are all interesting parts. But even here, perhaps, and here, as we expect wave C's. All right, now how to trade it, that of course is something we'll dive into soon. We'll have to use trend lines, fibs, fractals, to basically measure what price is going to do. Is it breaking, bouncing? That will give us info within this roadmap. For instance, here, let's focus on one particular example of the wave structure, which is a wave 4. Something that happens very regularly. We see a wave 1, 2, a massive move, and then a correction. So in this case, you can see green indicating wave 1, 2, 3, 4. All right, and wave 5 is expected. So how can we trade it? Well, wave 4 is not something we want to trade, ourselves typically. Even a wave 4 is tradable, to be honest, if we're looking at a weekly chart, for instance, and it's a massive wave 4, then on a 4-hour chart, there's still plenty of trades to be taken. If we're looking at a monthly wave forward and a daily chart, there's still plenty of trades to be taken. So it's not impossible. I'm not saying. It's just that wave 5 is better. It's better to wait for wave 4 to finish and wait for wave 5 to trade. Now, if it's a higher time frame, that may take ages, right? And there's still a lot of space within the wave 4. On the lower time frame, it could still take a while, but not as long as the weekly chart. So then, typically, if the chart is a lower time frame, hour, 4 hour, maybe for sure 15-minute, you want to skip wave 4 and wait for wave 5 to start. So how do we know in this particular structure when to trade it? So we can use the tools I just mentioned. We put a fib on the wave 3 on this particular swing high, swing low. A wave 4 will typically retrace shallow, right? So I know we haven't covered that in this webinar, but we did in previous webinars. So I'm kind of building off of those webinars in the past. So just for now, just assume, right, that wave 4s are shallow, which means that price typically retraces back to a 23.6 or 38.2 fib, max 50 typically. So those are important resistance levels. All right, it could be turning spots. If we see patterns like a potential rising wedge, that will only help the wave 4 structure, that this wave analysis is correct. But what happens if price then starts to break above like this, right? Well, then this is not a wave 4 anymore. Bullish candles like that pierce through resistance fibs are invalidating the wave structure, right? That would not be good. But if price stays choppy, stays corrective, stays below the 50 fib, preferably below the 38 even, but okay, then yes, this is confirming, the movement of price is confirming a wave 4. How do we know when to trade it? We can trade it at the fib, because that's a strong resistance point. It's a decision zone. So we could trade it at the 38 fib. We could trade it at the 50 fib, potentially. We could trade it upon the break of this pattern, below the purple lines, right? Once price breaks through that could be a bearish breakout. Or we can trade the pullback after the breakout. Or we can trade the continuation after the pullback for that wave 5. Those are all possible setups within the transition from wave 4 to wave 5, or the start of wave 5. So all of us know how this chart ended up, because this is the Eurodollar weekly chart from 2.5 years ago, right? And did this pan out? We can take a quick look, right? But basically, yes. As I open up my charts to show you on this particular screen, you can see that price hit the 38.2 fib, price made a correction, and then made a lower low. So bounces, breaks, confirmation, invalidation. Very important to have an idea where your analysis is confirmed, where you want to trade it after it's confirmed, and where is it invalid, where is it not as we expect. That will keep our feet on the ground. All right, because otherwise we might be with our head in the sky, in the clouds. That can happen sometimes with waves. It's true. But if we have invalidation, confirmation, and we know how to, once it's confirmed, how to, what type of methods we want to use for trading, whether it's trendline breaks, moving average breaks, parabolic breaks, fib bounces, trendline breaks, or perhaps, I'm not sure if there are any traders in here, but perhaps my SWAT method that I use, right? My SWAT method is based on waves, based on Elliott wave patterns, basically. And I have created that system so that traders can trade the waves without counting the waves. You don't need to know the waves. You can, sure, if it's a hobby, if you like to do it, you can. But my system is meant for actually traders that are not wave traders or light wave traders and use it a little bit so that they can capitalize on the wave movements, understand the structure without going into detail of the waves. It's not needed at all, and still capitalize on those waves. But I also add, information about trading waves as well, if for those that are interested, right? But that's why I like the beauty, because I call it simple wave analysis and trading. That's why SWAT, right? So within my SWAT system, I have triggers, I have entries that are indicated by candles, that are indicated by arrows. So whether you use that, or trendline breaks, or candlestick patterns, or moving averages, or fibs, but those are the classical methods to trade a reversal or a bounce at the 38 or break of this chart pattern. And let's take a quick look here on the live chart. There we go. Maybe let me refresh this 1 second. All right, so I think we were back in here somewhere, I think. Let me check. Yeah, June. Sorry, June. So where is that? June 2000, here. Somewhere here. So indeed, price did go to 38.2 fib. When we put a fib from here to here, you can see neat hit a few months later, making up that up to the the continuation to the 38.2 fib and then bouncing from it. You see that? But then it rechallenged this bottom and didn't break below this bottom, right? Because we had a complex correction. This was one part of the correction. This was another part of the correction, right? This was another part of the correction, and then this. What happened? Probably a triangle, right? This was probably an A, B, C, D, E. All right. So when we were all the way here, I was already indicating it was wave 4, and that happened. And look, because it was a weekly chart, how much time it took to complete this triangle after hitting the 38.2 fib. Then it made a downside, right? A short one, making a lower low. This is probably wave 5, and now, in my view, we're getting an A, B, C. And this is still part of the A, and we're still developing an A, because this is momentum, and this is looking like a wave 3 within wave A. So, trading wave 1 itself is not easy, because you would have to trade this part. It can be done on a weekly chart, for instance. You can use that weekly chart to trade on a lower time frame. So, for instance, if here you see a couple of bullish candles, you might be inclined to say, okay, this could be a bullish bounce, and you want to trade part of that, right? So 2 bullish candles, let's say, and take a look at the 4-hour chart there. Typically, you're trading a little bit against the trend on a wave 1. All right, why? Because price has been in the opposite direction till that date. All right, there we go. All right, so on a weekly chart, we're in a downtrend, but here you can see already price in uptrend, right? You can see here price above the moving averages. So we can try to trade pullbacks as price establishes itself above the moving averages. We can take a fib from here to here. We saw a break like this already before that, so this could be a pullback, right? Break, pullback, continue. After price on the weekly chart has shown 2 weekly bullish candles, right? We wouldn't do that without it otherwise. And you see price making it up all the way to the minus 61.8 target. So how do we trade that? How do we trade this bounce? You can look for candlestick patterns at the fibs here, for instance, right? Or you can trade the breakout after that. So we have the break, the pullback is one option, the continuation is another. Or we can take a look at lower time frames like this and try to see, is there something here of a candlestick pattern that would make sense to trade? Or is there a trend line break right here, right, on the lower time frame that indicates that this pullback is over? So you can drill down into lower time frames, right, and try to catch more understanding of this part. So on the weekly chart, price was in a downtrend, but it showed two bullish candles. Therefore, we're thinking about a bigger correction or a wave one. So we're interested in trading a reversal to the upside. We zoom into the 4-hour chart, we see a break and a pullback. Right? When is the pullback going to be finished? Right? We see that the pullback itself is choppy. So what is the confirmation? The confirmation is the break above this trend line, because then this choppiness is over, or the break above this trend line. Another confirmation that this choppiness, this channel is over. So the break of the trend lines are confirmations. What would be an invalidation? Invalidation would be at this bottom. So with wave analysis, we're always doing what if, thinking what if, thinking about invalidation, thinking about confirmation, thinking about how to enter. But you're letting basically not yourself decide. You're making analysis, you have a bias, but you want to keep yourself in check by setting up these levels of invalidation, confirmation, and that will keep you basically, as I said, with your feet on the ground. So a wave one is often not easy because it's still counter trend. But if we see good candlesticks confirming a turn, if we see that price is bouncing at a strong fib, for instance, so wave, for instance, here on the odd USD, right? So this bounce here, I was looking at the bounce. Why? Because price had hit a bigger fib. I put a fib like here, right? I was looking at bounce here, and I was confident about that trade because overall the trend was up, obviously, right? All right, so this is not a wave 1, 2, actually, maybe not a good example of that. So let me dive into a lower time frame. Here, we have a correction lower, right? Like this. We see that there's momentum. There's a correction, 3-wave correction here, like this, right? So we have momentum to the upside. We have an A, B, C. So how can you trade the potential wave one that is starting somewhere here? We have to establish where the support level could be, right? So we could put a fib from here to here. And we know that there was a previous bottom here and a 61.8 fib. So that's a potential bouncing spot, right? So that itself could be a trade. It's a risky trade, it's possible. Or we can trade the confirmation of a bounce, which could be the second bullish candle here, or a bullish candlestick pattern, if there were one. That would be the first reaction to this bounce. The other way could be to zoom into lower time frames and try to catch a piece of this part on lower time frames. Wave 2 would be when this push up is finished, price makes a correction, is to try to trade basically this correction back down. All right, here we need definitely candlestick confirmation sticks to confirm that. Otherwise, it is risky to trade. It's still trading against the momentum. All right, wave 3 is the most interesting one. And basically, there's the biggest momentum. We'll save that for the last. And the cool thing about wave 3 is that whether price is in a wave 1 or 2, right, or A, B, it doesn't matter. We're still expecting one push up. So let's say we have 5 waves up here, and we're not sure if this is a wave 1 or A. it doesn't really matter because in both cases we expect an A, B, C, and then we expect upside. This is A to wave 2 or B, and this is a wave 3 or C. There's confluence down in here that we expect a bounce and an upside. It's irrelevant if it's a 3 or C because we both expect a continuation up. Now, it is relevant later on because a wave 3 will go further than a wave C. But for this particular sweet zone here, between the bounce of 2 and the first target of 3, it doesn't really matter if it's a wave 3 or C. We'll be talking about the wave 5 as well, just in a second. But first of all, I want to explain, before I dive into wave 3s, how I measure wave 3s. I talked about it last week too. It's my tool called Wiz tool. It's based on Fibonacci sequence levels. And basically what it says is that if price moves away from moving averages for a certain number of pips on an hourly chart, if it moves further than 144 pips without hitting the 144 EMA close, the long-term moving average, then we are in a momentum. And that's when we expect the most impulse. So what that means is that this is level 1, level 2, level 3. As soon as it breaks level 3, we expect continuation to level 4, eventually to level 5, and maybe even to level 6. That's where we can expect the most price movement. That's also when we could expect the wave 3. So this is my little secret. It's not that secret for traders that join the webinars with Admiral Markets, luckily. But I use the Wiz tool to find the space where price moves the most. This is the key tool to determining if there's a wave 3 coming up or not. It cannot be simpler, it cannot be any easier, and it doesn't get better than this in my view. It's the ultimate tool for knowing if there's a wave 3. So if you are interested in trading with waves and you do think that the wave 3 is the best, then get the Wiz tool by sending me an email. Why? The wave 3 is the best. Why? Because we expect the price to move quick in one direction and covering a lot of territory. That means good reward to risk ratio and not so much trade management decisions, not so much choppiness, and the trade goes our way quickly and the target gets hit quickly. Everyone wants to trade that piece. It's the best piece out there. It's difficult to know though whether price is in a wave 3. It could be a wave C, as I said. So when using the sequence levels, the Wiz tool, you will be able to identify when price is in a wave 3. Magic. In some ways, yes, in my view. It's very, very cool. I love this tool. So trading the start of wave 1 can be good on lower time frames. If the higher time frames are up, definitely. Even sometimes wave 2 on a higher time frame, right? It can be possible. But wave 3 is always the most lucrative. And therefore, whether there are two ways of trading a wave 3 or a couple of ways of trading a wave 3, that is either trading the start of wave 3, so after the first 5 wave up and then the ABC right here, that's the start or close to the start. That's good too, because whether this is an A or 1, as I just told you, or a 2 and this is a 2 or B, doesn't matter. We're expecting a 3 or C. So that's a good spot too. The key ingredient to trading that is that this needs to be momentum. There needs to be momentum up or down, 5 waves and an ABC. And then it's a good approach to trade this bounce right there. So that's tip number 1, to trade the third wave or the wave C. Tip number 2 is using this Wiz tool, because eventually price is going to break above Wiz 1, Wiz 2, Wiz 3, and boom, it has the space to Wiz 4, boom, it has the space to Wiz 5. And that's where we can kind of capitalize on the extension of that third wave rather than the start of the third wave. Do you see the difference? The number 1 tip for trading waves is looking for 5 waves and looking for momentum. That's how you can trade, that's how you can recognize that there's a wave A or a wave 1. Then wait for the pullback to the fib. That's the first best way of trading the wave 3. The second is waiting for price to move away from moving averages, go beyond the third wiz level, and we'll be trading basically the wave 3 of wave 3. So these are the best methods. Find 5 waves, find momentum. It's the best way to trade wave 1 of 3. With the Wiz tool, it's great to trade the wave 3 of 3, the wave 3 of 5, the wave 3 of 1, the wave 3 of C, the wave 3 of A. Doesn't matter. All right. So that's a bit about the Wiz tool, right? Breakouts are great for that, like this, break continue, or like that. Breakouts are good for such momentum because price is not going to pull back that much. All right, wave 5, basically after we've had 1, 2, and a strong wave 3, you've got a triangle wave 4. While waiting for the triangle or waiting for the bull flag to break is often a good way, right here, trading that bull flag break to trade a wave 5 for one more push up and the wave 5. So once again, wave 1, 2, 3, 4, 5, breakout, good moment to trade wave 5. So when we look at the wave 5 sequence, right, let's put it very clearly like this. Right, and then we get the ABC. The best, in my view, is trading this bounce here after clear 5 waves has been established in this part. Trading the Wiz 3 right there, and maybe even here, and maybe even here. Right? And taking the first breakout here of the flag. All right, so those are typically the best 5 spots for trading it to the upside. Now, there are other spots too. We could trade the reversal. 1 second. We could trade reversals. We could trade the reversal here, the very first push of wave A. We can trade this part still downwards, right? Why? Because there could be a resistance. There could be still a downtrend valid, right? So that could be possible too. Take the bounces. Those are reversal trades. Or as price makes an A, B, C, we can try to trade the wave B here as well. Wave 4, I'm not interested unless it's on a higher time frame. Let's skip that for the moment. But we can try to trade the reversal here, the start of wave A or the continuation of wave A. And we can try to trade the beginning or the middle part of wave C. But those are reversal trade ideas. And if you are trading a wave A, you're looking for a reversal candlestick pattern. If you're looking for wave C, you can look for a candlestick pattern at a fib or the break of a trend line. And if you're trading a triangle and a bounce within the triangle, then you're looking for candles at support or resistance. All right, so each wave has their own preference. Wave 1, fibs are great, bounces at fibs or the break of fractals on lower time frames. Trading a wave 2, the start of wave 3, it's good to see momentum of the wave 1 and look for a pullback. Wave 3, once again, looking for breakouts within the Wiz. Wave 5 is good to trade a break of the chart pattern. And wave A, reversal candlestick patterns. Wave C could be reversal candlestick patterns or the break of a trend line. And the triangle itself, we're looking for candlestick patterns at support or resistance levels. All right. Let's take a look at some live charts now. If you're interested in knowing more about basically the Wiz tool, you can write me right there, Chris_Swarsik@hotmail.com. If you're interested in waves generally or my own SWAT system that is based on waves, simple wave analysis and trading, just send me an email. I can send more info. If you're interested in basically more part 2 of this, if you're looking at the recording later on, you can sign up for part 2 next week by going to education and Forex and CFD webinars. You can sign up for part 2 live. If you're interested in more wave analysis, how I do it day by day in, day out, how I label the waves. It's a good exercise to learn because you can test yourself and then compare it to how I do it. And you can see, is there a difference? What is the difference? Why? What do I write about it? What do you think about it? And you can learn and build experience like that. Once again, wave analysis is nothing more and nothing less than looking at connecting swings and connecting and analyzing their character, momentum or correction, and what will be the most likely part that fits as the next piece. So with the euro dollar, for instance, because I look at the euro dollar, pound dollar, dollar yen, I saw 5 waves down here. Therefore, I suspected that this was a wave B and expected correction for another wave C. And you could have seen that, and maybe that could have helped you in building experience. So if you're interested with that, analytics, wave analysis. Besides that, there are more wave analysis. There's also a ton of extra features that the MetaTrader 4 Supreme Edition has, by the way. And on WebTrader, you also have a neat way of adding waves. So if you like waves, you might want to try out MT4 WebTrader besides the Supreme Edition that has 60 extra plus features. Pound New Zealand, we can take a look at that. So my point is, find a way, in a way, to use patterns, wave patterns, in a method that benefits you. Not everyone has to be the top wave analyst, with a full wave count with alternatives all the way from the monthly to the 1 minute chart. It isn't needed. It might seem that way. You might think that is needed. You might see traders do that. It isn't. You can benefit from the wave patterns without going into that much detail. You can benefit from the wave patterns just by being aware of it and practicing a little bit. Practicing at times and using it at times when it makes sense without straining your eyes too much and looking for it continuously. If you like that, that's fine. If you want to learn the wave patterns, if you really want, if you enjoy it, if you think it's useful, and for most traders it is, that have started using it, it's often a question of starting. It's often a question of getting through the first few weeks or so. I don't know, first few days. It's a question of starting. Once people start often enough, they stick to it. Not everyone, of course, but in my view, in my experience, most, yes. Because once you get used to even slightly understanding the market structure better, because you use wave patterns and you understand the psychology behind them, you can't go back. It's difficult to go back. It's like you just have this different perspective. You have this different paradigm. Looking at the charts will not be the same after that. Well, you will start to look at it from a different angle. You'll start to see things and patterns, and it's difficult to ignore that. So often enough, it's just a start. Once you go through the start a little bit, it will be difficult. Often enough, people continue with it because it gives so much value. Not for trading purposes right away, right? But for understanding the market structure. With trading purposes, take it step by step. Try to look for zones and spots where there are higher probabilities. So let's take a look at this pound New Zealand. So let's start off the higher time frames to get a bit of a structure and feeling for it. For the pound New Zealand, we can see on the monthly chart. A couple of bearish candles in a row. Last one was a bit of a doge. All right, so we don't have to do any wave counts on this. Just get a sentiment for it. Price is going sideways for a couple of weeks, but within a downtrend, as you can see on the daily chart, price could have made potentially maybe some ABC correction here, and we're back in a downtrend. All right, so this could be a wave 1, 2, wave 3. Why? Look at this momentum, big momentum, right? And this could be wave 4. All right, so how do we know that wave 4 is over? Well, we can put confirmation on it. We can put trend lines like this. Say if this trend line breaks, this is the end of wave 4, this could be the wave 5. We can put a fib, that's the confirmation. We can put a fib on the wave 3 itself. And we know that price typically does not retrace more than the 38.2 fib. Price is respected to 38. This is ticking off the boxes for a wave 4. Price typically does not go back above wave 5, the 50 fib, and definitely shouldn't go back above the wave 1. That's the rule. So far, it looks like a wave 4. We have an invalidation level, which is actually this bottom, right? But we also have a 50 fib, which makes a wave 4, a break above that, which makes it less likely. This is right here, this is invalidation. This is less likely. And the confirmation is this, right here, the break for that wave 5, right? We have a resistance trend like that, all right? So we're in a triangle, waiting for a break of the triangle. We can zoom into a lower time frame to understand the triangle a bit better. And we can see that this could be a wave A, this could be wave B, this could be C, this could be D, this could be E. This could be the last push within this triangle. So if this is a wave C, that means that price could not break above this top, otherwise the triangle is invalidated. The E cannot go above the C. The E can stop anywhere but not above the C. And if it breaks below this bottom, which is the wave D, then we have a confirmation of a triangle break to the downside. So what within wave 4, what we just discussed, when we look at this formation, what do you think is the most interesting direction to trade this pound New Zealand? Short or long? All right, that question is for you, by the way. It's not a rhetorical question. It is actually intended for you. What do you think makes most sense? Short or long? If you had to choose. Eric has this interesting answer, which is wait. But if you had to choose. All right. So the correct answer is, and if you have the wrong answer, don't get discouraged. It is short. And the reason is, let's go back to this daily chart. The reason is that we're expecting a bearish wave 1 here, wave 2. This is a bearish wave 3, and this is a bearish wave 4. This is a 5-wave bearish pattern. When we have a bearish 5 wave, we expect the wave 5 to have a lower low. This wave 4, although price is ekingly going up like that, we expect should not go too high before turning and falling for this wave 5. The confirmation that wave 5 has started is the break below the trend line, and we can expect to push down. The invalidation level is here. In that case, this analysis is not valid. But a break above the 50 fib would already make us doubt. So if price does push up higher, then something else is going on. And this wave analysis is invalidated. I might have lost money on this trade or not, because sometimes I have an analysis, but I don't take a trade. I have an analysis that says I'm interested in trading it, but I don't get a confirmation from price. I don't see any candlestick patterns that confirm an entry. I don't see any break. So the analysis is a bias, but doesn't mean that I will always trade that bias. I will try to trade the bias when it's confirmed. And sometimes I don't get the confirmation, which is easy for me. I missed a loss, which is good. I avoided a loss. So those things happen. Confirmation, invalidation. And then how do we enter? So basically, if we zoom in back to the 4-hour chart, if this is a wave 4 and this is a wave E, we can put a fib from here to here. Price should not break above this top, otherwise it is invalidated. No, sorry, from here. Well, I'm not sure. Let's see, A, B, probably from here. Let's leave it there for the moment. All right. So at the 61.8, basically it could turn at any spot. So of course, this is still quite a spacious stop loss to put the stop loss all the way up here and take the trade here because it's quite a big space. So obviously, I'm not suggesting that this is the space, the place to take a trade. What I meant with my question was like, if you had to choose, what side would I choose? And then it would definitely be short. If I had to take a trade, I would take it here, put the stop loss here, and aim for the, let's take a look. Aim for the minus 272 target right here at around 169-ish, right? Is there a good reward to risk? Yeah, that's the reward. This is the risk. It's a potential 860 pips versus about 180 risk. It's a very long-term trade. It's a very big trade. And not everyone's going to like it. But it is a long-term trade. You know, if you have a big account, these types of trades are more tradable and are trades that people might think about because the reward to risk is there. It is about 4-1, if not more, 4.5-1 maybe, or 5-1. So even if this trade works out in 1 or 2 times, it's highly profitable. Even if it's 1 out of 3 times, it's still highly profitable. It would really have to work out less than 20%. Otherwise, then it would not be profitable. Well, probably it will. Of course, this ratio could get better if price does push higher, the 78.6 fib, right? That would be ideal because there's a trend line there too. Then the reward to risk gets even better. So candlestick patterns, a bearish engulfing twin here, for instance, could be a confirmation of a bounce, a confirmation pattern, or a pin bar as price hits the 78.6 fib, for instance, and there's a big wick like that. That too could be a confirmation of a bounce at the 78.6 fib. And we can continue. We can zoom into lower time frames and look, are there additional reasons for a turn at resistance? Maybe yes, maybe a slight rising wedge, right? So the next push up could be within this rising wedge, and then boom, rising wedge breaks, and that could confirm the bounce at the 78.6 fib too. I know that could be confusing to mix time frames, to mix tools, to mix patterns like this, but ultimately it gives you a lot of flexibility to tackle the market. We know that from a high time frame, weekly, monthly charts, prices in a downtrend. Let's recap this. We know that from a weekly time frame, one second, folks. Weekly time frame, this could be a complex correction or it's a continuation of the downtrend. We really don't know for sure. It could be a complex correction too, by the way. All right, this could be an ABC, this could be ABC, and up we go with another ABC to make a complex correction. So that's something we have to be aware of. Okay. Therefore, break of this trend line is important because then it's probably not a correct, or maybe it is still a complex correction, but there is in any case the space between the breakout and the bottom. So that space is there to the downside. So this is a confirmation level for downside break. The target here. All right, once again, daily chart. there we see triangle. We know that this could be a wave 4, but if it breaks above this trend line, it breaks above the 50 fib, it is probably a complex correction. This is probably an ABC. This is maybe an ABC, and up we go for an ABC. And if it breaks below the trend line, we're in a wave 5. So both these trend lines have purposes. They're both confirming different things and invalidating other things. So waiting for that confirmation makes sense. And if we then zoom in lower, we see momentum and we see a triangle. And then that kind of shifts the odds to a bounce here and a breakout here. But once again, here too, we can wait for confirmation of candlestick patterns, trend line breaks, pattern breaks, candlestick bounces, fractal breaks, moving average breaks to trade this bounce to the downside, to trade this breakout to the downside, or maybe, who knows, to trade later on the breakout to the upside. All right, folks, that brings us over the webinar time actually already. Time flies, I didn't even notice. So if you're interested in this risk tool, feel free to reach out. Of course, feel free to check out that YouTube channel. I mentioned also before with regard to momentum correction and wave patterns, wave webinars we've had in the past. Just go to this YouTube channel and search for the keywords that you are interested in. A lot of analysis and webinars, of course, next week again. And you can find out more information about MT4 Supreme Edition with ironmarkets.com. And hope that this kind of gave you a little bit more structure without going too much into rules and guidelines, but just to kind of intuitively use the impulse and correction and the patterns that appear naturally to your eye when looking to the charts. But once again, there are wave webinars in the past that dive into the theory in more detail as well. All right. So I'm glad you were here. I mean, waves is a topic that's close to my heart. So I always have fun and happy that you were here. And wish you all great trading. Cheers.